U.S. stocks slip after weak retail sales and inflation data, while gold surges. Also on the show, Peter Schiff, president of EuroPacific Capital, joins me to discuss his company's new partnership with GoldMoney. This is the Power and Market Report for Friday, August the 12th. It's 10:25 on the East Coast, Friday, August the 12th. It's great to be with you today, coming to you from Boston. And we have the U.S. markets slipping after some weak sales data and inflation data. Gold seems to be doing well on the news, up $7.10 to $13.57. Silver doing well, up over 0.5% to $20.15. Oil up 38 cents to $43.87. So it seems like the madness continues. This morning, Bloomberg had a article, or at least a paragraph in their 5 things you need to know to start your day. And it started with party like it's 1999, reference to Prince, of course, because yesterday we had the 3 benchmark indexes of the U.S. equity markets closing at record highs. And this is the first time that it happened since 1999. Bloomberg says this continues the rally in U.S. stocks, forcing analysts to revise their S&P 500 targets higher, with Wells Fargo and Company raising its 12-month expected level to 2,200. It continues in Europe. It is more a case of party like it's late June, as the Stock 600 index erased all of its post-Brexit losses by yesterday's close. So clearly this QE that we're seeing, the easing out of the Bank of England, this is all having an effect. I guess not unexpected. This has been the theme for many years now, so we'll have to watch that. Also, it looks like the UK property market is finally starting to slow down. I saw an article there again out of Bloomberg. Don't blame Brexit for London's housing chill. Looks like the market there is slowing down, especially in the London area. Seems to be that is the region's worst performer, and they're actually into negative growth. And the focus of the article here is not to blame this just on the Brexit, though. If you look at other centers, financial hubs, and they look at Switzerland for another example, you see something similar happening there. But today I have a really big treat for you, because I was able to catch up with Peter Schiff at FreedomFest, and that is the interview I have for you today. We had a really good discussion on the usual macro stuff, so about what's going on with the Fed, interest rates, the possibility of QE, sort of his regular stuff. But we also had a chance to talk about his company, Schiff Gold's merging with GoldMoney. And I thought that there was a little bit of stuff to cover there, because Peter was an outspoken critic, probably the most outspoken critic of GoldMoney not too long ago. And now the companies have merged, and he's obviously on board. So I wanted to know what has changed, whether his criticisms still stand. If he was wrong, why was he wrong, and so forth. So we had a great discussion about that. And I also, just before that, I asked him about the U.S. Treasury market. And the reason I did is because obviously Peter is a big gold bug, and he thinks that that is the best way to store and preserve wealth. But it's pretty clear that U.S. Treasuries have done well, even at a time when you think that they wouldn't have done well, and particularly this year. So year to date, we're up, over 18% on the long bond. So I asked him about that, and he said, well, it's a bubble, which clearly, if the Federal Reserve is buying these, it stands to reason that it is a bubble. But I wanted to know what he thought about the short-term prospects for it, because it's gained a lot. If you look at the iShares product, the 20-year plus Treasury, that's gained, like I said, over 18% this year. And obviously it's been a very good safe haven for people who are looking to protect themselves from the stock market. And he said that, well, it's a bubble, and not only that, the only way you really made money on this is that if you bought it with leverage. And I disagreed with that, and I tried to explain that, well, there's leverage in terms of, leveraging interest rates because it's a higher duration product, but this is not a leveraged. This particular ETF is an organic ETF, so there is no leverage here, and we didn't really get anywhere. And I wanted to move on because I wanted to get into the GoldMoney discussion, but this is something I think we should follow back on and maybe talk to him some more, because my understanding of this is not leverage. This is purely organic. This is just buying the treasuries, and just the way the interest rates have moved, we've done pretty well on these. So that was one point that I didn't get to resolve, but at some point I'll circle back on that with Peter. So without any further delay, this is my interview with Peter Schiff, president of EuroPacific Capital. Here at FreedomFest 2016 in Las Vegas, I got with me today Peter Schiff of EuroPacific Capital and Schiff Gold. Peter, thanks for joining me today. How are you doing?
Good, how are you?
Great. Enjoyed your talk, Peter, on the panel. It was a typical bull-bear kind of stuff we saw in 2006, 2007, where the bulls, the bears made a good case, but the audience was kind of with the bulls. And this is sort of what we saw before. And I think we're basically at the same point, that pin is going to find the bubble. And it could be this year, it could be early next year. So what are your reflections on the panel that you just came out of?
Well, basically it's the same concepts that I tried to get across last year, that I'm not bearish on the market and that I'm suggesting that people go short, because I don't think the Federal Reserve is going to allow the market to fall substantially. I mean, the market is overpriced and it needs to come down, but part of the Fed's policy is to prevent that from happening, and they're able to do that. But you still have to understand, as an investor, what's important are real returns, not just where the nominal price of stocks are. And you have to understand what's happening in the U.S. economy. The fact that the economy is so unhealthy, and these cheap interest rates and money printing that is designed to prop up asset bubbles and to finance deficit spending, is not only not going to help the economy, but it actually undermines real economic growth. So investors who are looking for real returns need to look elsewhere. And I mentioned on the bull-bear debate that stocks are basically, even though they're at a record high, they're barely higher than they were 2 years ago. I mean, 1% maybe, and even the government CPI is up more than that. I mean, as rigged as it is. But I think we've just started to see the turn this year in other markets, where you have gold stocks up dramatically this year, many of them up double, triple, quadruple, in some cases, silver stocks. And now we're starting to see movements in emerging markets as the US dollar is starting to come down. So if people are bullish, they need to be bullish outside the United States and on different asset classes, because even if the US stock market goes up, it's not going to go up enough to offset the declining value of the dollar. And I also pointed out, in terms of gold, the US stock market is at multi-year lows. So the high for the stock market in gold terms was over 16 years ago. So we're not making any real progress. It's just that stocks are losing less value than dollars.
Yeah, Peter, and I think that point was misunderstood on the panel, because the point of indexing or measuring, denominating the Dow in terms of gold, is not to compare the two as investments, but just to get a fair reading on what the real value of the Dow is now, or the S&P.
Yes, I mean, and gold's not an investment. I mean, gold's money, and so gold is a way that you can measure how your investments are doing. Are your investments gaining in terms of gold, or are they losing in terms of gold? Because if you're not gaining in terms of gold, then the investment's a failure. Right? You need to increase your wealth as measured in gold, and you're not doing that in the U.S. stock market, nor are you likely to do that in the near future. Now, you can always point to individual stocks that did well, but that's with the benefit of hindsight. You don't have hindsight when you're choosing your investments in real time. And if you just had a broadly diversified portfolio, you have lost ounces of gold. You haven't been gaining ounces.
Right, and the reference Peter is making is to the gentleman who basically cherry-picked 3 or 4 of the most successful tech companies in the history of the U.S. stock market. Microsoft, Apple, what else? Facebook.
And maybe Amazon.
Amazon.
Well, if you had just bought these stocks, you'd have made all this money. Yeah, I could rattle off a bunch of names that went to zero, too. So.
Right, far more, actually, and far more as a I think, representation of the picks that were available at the time. No one knew. But despite all of this, the bullish sentiment, and I'm sure like we're not watching CNBC right now, but I imagine that they're having a party there right now. But I have noticed a lot of Schiffisms popping up because, essentially the Fed has basically completely reversed its course. Even though it hasn't cut, its posture has completely changed from where it was in December.
Oh yeah, when the year started, everybody was convinced that rates were going up. People thought at least 3, maybe 4 rate hikes in 2016 and then more in 2017. And now the majority of investors believe that the next move by the Fed is going to be to cut rates, not to raise them. And that's what I said at the beginning. I said this back in December. And that's why the market was originally selling off, because nobody believed me. They believed what they thought the Fed was telegraphing. But now that the Fed has completely turned, that is the reason the market is going up. It's not because the fundamentals support higher stock prices. It's because the Fed is, pouring more alcohol into the punch bowl, and it's restarted the party.
It has. And as this has happened, like I said, I'm noticing certain Schiffisms showing up in popular media. Roach Motel, heroin shots, okay? People saying that no rate hike in 2016, maybe none in 2017 if you look at future sentiment. But I also heard a guy on Bloomberg actually say that the reason that gold has not performed better is because of the anticipation of rate hikes that are now not coming. And that's a point that you've made a long time, that the market has priced in rate hikes because they think that what basically the stimulus has worked, but really it hasn't worked. And now you're seeing gold respond to that.
And it's just barely, as they're starting to reprice it or revalue gold based on this new information that really isn't new. I've had this information all along. I knew the Fed was bluffing, that they couldn't deliver the rate hikes that everybody thought they were promising. But now that people are reevaluating those premises, now they're revaluing gold. And it's just started. I think gold is going to recover all the ground that it lost from its highs, and then it's going to make new highs because the government, the Federal Reserve, has just started with the money printing. I mean, it's far from ending. There's a lot more QE coming than has already taken place. We're early in the money printing, and ultimately, I think we're going to have a currency crisis.
So the next step probably is for the Fed to confirm what the market already knows, and that is there's no rate hike coming this year, probably nothing next year.
I think they're going to take their time, though, because basically the entire time they talked about raising interest rates, that was kind of the tightening.
Right.
And now the easing is going to be the rhetoric changing because they don't have much to go as far as actually cuts, because we're only one cut away from zero.
Right.
So I think the Fed is going to try to gradually adopt a softer and softer tone to try to ease monetary conditions by extending the time period where it's finally going to maybe raise rates.
Yeah.
But eventually it's going to have to shift the conversation as the economy gets weaker and weaker and the markets need even more stimulus. They're going to have to actually start saying that their bias is to a cut, right? That they're not looking to hike rates anymore, that now they're actually thinking about cutting, but not cut, and then eventually cut, and then go back to QE and do everything that they can, but they have to lengthen the process, because they don't have a lot of rate hikes, because when they started the last time, they were above 5%, and they went all the way to zero. Well, now they're starting at 0.5% or 1/4%. So there's not a lot of distance between where we are and where the Fed can go.
Right. I've made this point to my viewers. It's not interest rates per se now. It's the rate of change of interest rates or the rate of change of the rate of change of interest rates, meaning their opinion of what's going on. Would you agree that the tightening phase actually began with taper? So we've been tightening for a long time?
It began before the taper. It began when they started talking about tapering.
That's true.
The taper talk was the beginning. So they talked about tapering. Then they actually tapered.
Yeah.
And then they tapered for a long time. And then after they finished tapering, they talked about hiking. And so by the time they actually hiked, that was the end of the tightening cycle. Right. Everybody thought that was the beginning, that was the first move. No, that was the end of it.
Yeah.
And I said that at the time, and I said the markets are now going to start pricing in the next ease. And that's what they're doing.
So it's funny. So in my view, the only reason the Fed ever tightens is so that they have ammo to loosen with. And they didn't get far off the ground here. So they're gonna milk this for as much as they can. Eventually they're gonna go to zero. And then you're thinking they're gonna go QE. What are they gonna buy this time?
The same stuff they bought last time. There's still a lot of treasuries out there. But eventually they might end up buying corporate bonds. They might end up buying municipal bonds. They could be buying all sorts of things, because the Fed is going to try to keep interest rates low for everybody, not just the U.S. government. So that's going to mean buying more than just U.S. treasuries.
Right, and as many of them as are out there, they may have a problem, I guess, dislodging enough people and have to go further and further, like the ECB is doing, further and further out. When we talk about the pin that eventually is going to burst this thing, what do you see as the most likely catalyst? Because it's very complicated now. It's not like in 2004 when you said, look, real estate, Fannie Mae, Freddie Mac, this thing's going to blow up subprime, right? Now we have whatever's left over from that problem that didn't get liquidated. We have the banking problem in Europe that they're grappling with. We have junk debt in energy. And then we have China that is not nearly as bad off as we are, but their GDP is clearly slowing. Do you see one of those things or something I haven't mentioned that's going to be the catalyst?
No, I think because the crisis I'm looking for is a dollar crisis and a U.S. sovereign debt crisis. And the catalyst there, ultimately, I think, is going to be the realization that the Fed is boxed in here when it comes to inflation and rates. The Fed talks a good game about how, if inflation ever picks up, they're going to fight it, they're going to raise rates. But it's all talk. They can't raise rates, and the markets are going to realize that eventually as the official measures of inflation really start to heat up and the Federal Reserve refuses to do anything about it, because they can't. And so at some point, people are going to figure this out, and then you're going to have a run on the dollar. And then you're going to see a real acceleration in U.S. inflation, at which point the Fed is going to have to make a very difficult decision. Does it aggressively raise rates and crush the U.S. stock market, the U.S. bond market, the real estate market, bring about a financial crisis worse than 2008, force the U.S. government to default on its national debt, allow all the big banks that we bailed out to fail? Are they going to do all that? Or, because they don't have the stomach for that, are they going to do something even worse, which is going to be to allow the dollar to crash to where we have runaway inflation, hyperinflation, so that they render Federal Reserve notes practically worthless? I mean, those are the two choices. Neither one of them is going to be pretty.
So that final outcome would be kind of, in your language, the real crash.
Yes,
because
yes.
There's another crash that's going to come before that will basically force the hand and force the Fed into that situation. But one of these things is going to be the next, at least, stock market crash or asset price crash.
Well,
right?
the Fed has to choose. Are they going to crash the asset markets and bankrupt the U.S. government, or are they going to crash the dollar and bankrupt everybody who has U.S. currency?
But if oil doesn't recover, isn't that going to happen anyway?
No, oil is going to recover in dollars. I mean, the reason oil went down was because everybody believed the Fed was going to keep tightening and that the dollar would keep rising. Now that that's not happening, oil prices are recovering, and I think they're going to continue to recover.
Do you think it's possible that the dollar could lose ground against perhaps gold? Okay, what we're saying.
Well,
but
it's
then,
already losing ground against gold.
But at the same time, benefit from safe haven flow away from other currencies. The European.
Well, it temporarily did with the Brexit vote, although
Yeah.
the yen, got more of a safe haven bid than the dollar.
Yeah.
But I think as people start to really perceive the central bank response to Brexit, that is a dollar negative event. And so more people will be looking for a true safe haven, which would be the gold or currencies of countries that are not as overly indebted as like the United States or Japan.
Okay, I want to finish off talking about gold, but just one quick hit on U.S. Treasuries. I understand the case that it's insane to lend to the government for 30 years or greater. A lot of people make that case. However, in the short run, they've done really well. What is your opinion about using U.S. Treasuries, long dated, as not a credit instrument, but almost like a demand deposit, where you're counting on the market to be your bank.
There's a bubble in U.S. Treasuries, as there are in the equivalent sovereign debt in Europe, Japan. It's all the greater fool. Although in this case, the greater fools are the central banks who have already said, hey, we're going to buy these bonds. We don't care what the rate is. So you've got a greater fool that's already committed to spending other people's money to overpay for the assets that you buy. So this is the bubble. But this thing is a very dangerous game that people are playing, buying sovereign debt at zero or negative yields. When this bubble bursts, the losses will be horrific.
Agreed, but in the short run, as a treasury holder, could you now count on all of those people who are buying zero or negative yielding sovereign debt to instead come over and buy treasuries? As once they realize that the Fed is not going to raise rates and kill them?
Yeah, but if they're smart, they'll buy gold instead. Treasuries, you're trying to pick up pennies in front of a steamroller. Hoping that you're gonna, you get lucky, but it's not worth the risk.
Okay, look at the performance of the treasuries over the last year, though. It's more than pennies, right?
Well, I mean, if you're highly leveraged, yes, but then that cuts both ways. When that thing turns.
Leveraged in terms of duration, right?
No, borrow. Just buying if you actually just bought a treasury, I mean, you didn't really make that much money.
No, you did okay on the long dated ones.
The way they're making a lot of money is by levering up, by borrowing money to buy all these treasuries.
Okay. I want to finish up with GoldMoney because this was, I have to admit, Peter, this was surprising news to me when I saw it on your videocast. Schiff Gold merging with GoldMoney. I see the business case. Win for them, win for you, I think, obviously. There's a growth market there for Schiff Gold to tap into. And then BitGold or GoldMoney gets the Schiff following, all of the... you as a spokesperson, it's a win. But from the standpoint of the consumer, let's just talk about that, how it's a win for them. And I want to talk specifically about the criticisms you had of GoldMoney before, and this is the best way to attack this. Have the person who made the criticisms defend them now. Right?
Well, I never criticized it from a consumer perspective. I always said, hey, it's a great product to have as a consumer. My criticism was on the valuation of the company and the business model. It wasn't about the product.
Okay.
Just like I might look at Amazon and say, hey, Amazon's great. I mean, I use Amazon all the time. But do I think it's a good investment given the price that you have to pay for the stock?
Okay.
So it's the criticism that I had is, as an outsider was, hey, look at the market cap. Is it worth it? Because I always said it's a great idea. I mean, I had the same idea before they did.
Right.
I think gold is money, and when you pair gold with modern technology, you basically, you abrogate the idea for a middleman. You don't need currency. You don't need a central bank to hold your gold and issue currency. People can have their own gold deposits with GoldMoney, and they can use that as a source of savings and payments. People can transact in gold. You can earn gold, you can spend gold, and if you want to transact with the non-gold world, you can use your debit card that's attached to your GoldMoney account so that you can spend gold in a way that is the same as if you spent dollars or euros. But ideally, the real goal would be to move people out of the fiat system into a gold-based system where you can completely live your life on a gold standard. You can adopt your own gold. You don't need the government to do it for you. You can do it yourself. You can opt out of fiat currency and opt into gold. And, because what everybody always said about gold is, I have an ounce of gold. How do I spend it? Well, by having your gold stored at GoldMoney, and you can spend it with an online payment app or your debit card, you can instantaneously transfer portions of your gold holdings to anybody that you want. Whether that's your landlord if he wants to accept rent payments in gold, or whether you're the landlord and you want your tenants to pay their rent in gold. But you can, if you're a merchant and you want to sell your products, you can accept payments in gold. And if you want to pay for products in gold, if you have a job and you want your boss to pay the salary in gold,
okay,
or if you want to pay your employees in gold, all this can be done, right? Or even if nobody is using gold, you can have gold yourself in your GoldMoney account that you're saving, that is appreciating, but you can spend your gold, just like if you're an American tourist and you go to Europe and you buy something that's 10 euros. You don't have any euros. but you can still use your debit card. You can pull out your dollars and it will be converted to euros. We'll do the same thing with gold.
Right.
You can have gold, and then when you're traveling in Europe, you can buy something in euros. Even though you don't have any euros, your gold will be converted to euros. Or your gold will be converted to dollars if you're in the United States.
Those are all good points. If I could just jump in here, though, Peter, I know you were skeptical of the business model, and that is sort of important because unlike Schiff Gold, which was just selling bullion, you're selling bullion. I want you to be profitable, but profitable for the 2 weeks it takes you to deliver to me. When you have gold money, people are keeping gold on deposit. I know they're bailments, so it's not like you're a creditor, but still they are the infrastructure that accounts for it, moves it, everything. I want to make sure that that company is very profitable. So have you changed your opinion on the profitability of this business?
Yeah, first of all, even if the business isn't profitable, the gold is still owned by the depositor. So it's not like when you go to a bank, right, and you open up a bank account, you deposit $100. You've actually loaned the bank $100.
Right.
You're a creditor of that bank. Now the reality is they don't even pay you any interest on your deposits anymore. So you're loaning the bank your money and you're getting nothing in exchange. And if the bank fails, you could lose your deposit.
Right.
When you open up a GoldMoney account, you're not loaning GoldMoney your gold. They're just storing it for you. So even if GoldMoney goes bankrupt, that gold is still yours.
Right.
You are not a creditor.
Agreed.
But what really changed my mind about the business model is the conversations I had with Royce Bagg following my criticism. And one of the reasons that I wasn't seeing it is I was looking at it from the perspective of how I run my business and my bank. See, their business model is to generate income based on transactions, people buying and selling gold. And I thought, well, why would anybody sell their gold? I could see why they would buy it, but why would they want to sell it? I was looking at it from the point of view of an investor. One of my clients who says, let me buy $10,000 worth of gold because I want to have gold as part of my portfolio. They're not going to turn around and use that $10,000 of their gold to buy a cup of coffee. They're going to use their dollars to buy their coffee.
Right.
They're going to save their gold. I was thinking about it from that perspective, but what GoldMoney is going after is not that client. Not the guy who wants to buy a lot of gold to diversify his portfolio, but somebody who wants to put their paycheck into gold and use gold money instead of a bank account.
Okay.
So they're constantly buying and selling gold, but at the end of the day, hopefully that, let's say you buy gold and you sell gold and you buy gold, that you save a little bit, maybe 3 or 4 or 5% of your income is saved, and now your savings are in gold. But in the meantime, you're buying and transacting in gold, which is gaining in value, instead of dollars or euros, which are losing value. So if you think about it from the point of view of a consumer, thinking, okay, I want to run my life. I need a medium of exchange that I can use to buy and sell goods and also save for the future. And what am I going to pick? Am I going to pick dollars? Am I going to pick euros? Or am I going to pick gold? And I think if you choose gold, that is going to provide a better store of value and a medium of exchange.
Okay.
It's like, do I want to use the post office or do I want to use FedEx? Do I want to hail a cab or do I want to use an app and get an Uber? Right? I think that the free market will provide consumers with a better banking option, a better monetary option than the government. And that's really what I was looking at is because it's really a payment system. It's like a PayPal, only better, because you're using gold rather than a flawed government fiat currency. Because fiat currencies are a good medium of exchange. Although actually using a banking system and using the credit card system, it's actually cheaper for you to pay with gold than pay with fiat currency. So it's actually a more efficient payment system, but it's a much more efficient store of value, which is the most important part of money, is that the value is stored. Because dollars don't store any value because they have no value to store. They just depreciate by design.
Okay. One of the things you did at Schiff Gold was that you did not offer numismatic coins. And one of the reasons that I admired you for doing that is because the profit incentive on those coins is very high, yet we both know for most people it's the wrong thing to buy. So if people called I would send people to your firm because I knew that if they called Schiff Gold to get Eagles, they're going to get Eagles, or they're going to get Maples, or they're going to get Krugerrands, but they're not going to be talked into some levered account or some expensive numismatic coin.
Yeah, the biggest problem, in the gold industry, and of course, salesmen work on commission. And when you buy gold to buy bullion, and if you're going to get it at a fair price, the markups are very small. Maybe 1%, 2%, 3%, maybe if you're pushing it. So if somebody sells you $10,000 worth of gold, they don't make that much money. But if they can talk you into buying $10,000 worth of numismatic coins instead of the gold that you were interested in, now the commissions are huge.
Right.
Now they might make $4,000 or $5,000 commission off of your $10,000. Right. So there's a powerful incentive for the salesman to switch you into numismatics. And of course the employer wants the salesman to do that. So they also incentivize their salesman. And so we don't do that. I mean, we don't, there's no way for a Schiff Gold representative to make extra money if they can convince you to do something foolish.
Okay.
And that's not going to change with the partnership with GoldMoney.
Right, but this is the second part of the question. So I think you've said, and I firmly believe that bullion that you own, take delivery of, and store is a very different function than something you would keep in a bank account or a GoldMoney account. So the question is there a financial incentive now for people to steer Schiff Gold clients who are coming for bullion, steer them to GoldMoney accounts instead?
No, not really, because they'll probably make less money if they go to GoldMoney. I mean, because there's a little bit higher margin in the physical business than there is in GoldMoney. But basically, the way the two complement each other is everybody should still have physical gold. But you should also have some portion of your gold holdings with GoldMoney because it's more liquid. Right? If you want to spend the gold, it's a lot easier to do it through the GoldMoney account than selling the gold and converting it to cash and then spending that. So people should have their own physical gold that they store. They should also store some gold offshore, and they should store some gold with GoldMoney, because then they also can negotiate it very easily. They can have a debit card tied to their account, and they can actually have their gold on their cell phone. I mean, when you have a GoldMoney account and you have your mobile phone, you can use that phone to transfer any portion of your gold holdings to anybody else that you want to, whether you want to gift it to somebody or whether you want to use it as a form of payment. And more importantly, if you want to get paid, if you provide a service, if you're selling a good and you want to receive gold in exchange for that, you can do that even if the person paying you doesn't have gold. Because if somebody, let's say you have, let's say you're renting out your house when you're not using it, and you're renting it out and you want to be paid in gold. You can have people pay you into your GoldMoney app, and even though they're paying you with dollars or euros or yen, it'll be received into your account as gold. So you can increase your gold ownership, using GoldMoney.
Peter, if I'm doing that, say as a vendor, who pays the charge? Basically, if someone is paying me in fiat but it's going into my account as gold, who's paying the charge for that?
If they're paying you in fiat and it's becoming gold, then you're going to pay that like 1% to get the gold. But if they're paying you in gold and they already have the gold, then you don't have to pay that. But as a merchant, there is a fee that the merchant pays. But just like if you take Visa or MasterCard, it's 2 or 3%. You got to give to the credit card company.
Right.
So this is less.
So is it the person who's on the gold side that's always paying? So if I'm paying someone in gold but they want dollars, am I paying the 1%?
The merchant, if there's an actual legitimate merchant who's invoicing and selling something, the merchant is going to pay the fee, just like the merchant would pay the fee. But if you are, as a consumer, if you have gold and you want to convert to fiat to pay somebody, then it's going to cost 1% to come out of gold back to fiat.
Okay, awesome. Well, thanks for this discussion, Peter. I know you're busy. I really appreciate it. Been speaking with Peter Schiff, author of The Real Crash, president of EuroPacific Capital. Please check them out at europac.net. And Peter, always enjoy it. I hope we can do it again sometime.
Yeah,
Thank
and
you.
It's also europac.com now. I've got that URL. So.
I'm old school. Europac.net. Thanks a lot.
Thank you.
Yeah, bye-bye. Bye. Hi, I'm Albert Liu, host of the Power and Market Report. If you enjoyed this video, I invite you to subscribe to my channel by clicking the button on the top left of the screen. And don't forget, you can also visit us on Facebook and at powerandmarket.com. Thanks again for watching.